Your biggest enemy in trading isn't the market, it's actually your mind. Your mind will play tricks on you and put you into losing trades again, and again. By the end of this episode, you will be better suited to notice the tricks of the mind and overcome them. This is the Mind Mastery series, and today we will be talking about tricks of the mind. Tricks of the mind is something that affects all people, all traders. Doesn't matter if you're a beginner to experienced, they will happen over and over again. But if you can identify them, if you can be aware of them, you'll be better suited, and that is exactly what will be happening by the end of this episode. So stay tuned, let's go. Trick number 1, attachment. Falling in love with a trade, especially when it's a losing trade. Look, we all want to be right 100% of the time, but the reality is we cannot be right 100% of the time. Actually, impossible. You might have a win streak where for weeks and weeks or months, maybe even a year if you're lucky enough, you will continue on a winning streak, not have any losing trades. But probabilistically, that will not happen. Why? Because that is just not the way the markets work. There will be times when you lose, but the main thing here is attachment. And the thing with attachment is when you are too attached, you have your ego attached to it, you have your self-worth attached to it, and that's when hope starts to creep in. And when that starts to creep in, you're no longer relying on a strategy, but you're relying on emotion. You're attached. And really, the idea here is to be detached. Because look, when you have a losing trade, that is not a reflection of you as a trader or a person. It is a normal part of trading. So the idea here is that you cannot fall in love with a trade. You cannot say, oh, this is the perfect setup, I seen this coming, then it suddenly doesn't go your way and you start to get hurt. Why? Because the market doesn't care about you. And it is your job to detach from a trade, to detach from the market. Why? Because different market conditions, sometimes your setup is going to give you a false positive, and all these things are going to occur, sometimes more often than not. And so therefore, the best way to not fall in love with a trade is to detach from it. And once you detach, or once you become aware of attachment and you detach, then you will be better suited to continue on whether you're losing or winning. So that is trick number 1, not falling in love with a trade, detaching, no attachment. Trick number 2, revenge trading, getting back at the market. You enter the trade, it doesn't go your way, you suddenly start getting angry. What do? Instead of stepping away, instead of taking a deep breath, instead of going for a walk, you jump into another trade straight away. But guess what? You jump in with emotion, with anger, right? When you jump in with anger and all you see is red, guess what you don't see? Your strategy, your risk management, your entry and exit, your patience goes out the window. Why? Because all you see is red. Your revenge trading, you just want to get back at the market, as if the market cares about you as an individual, when in actual fact, it doesn't care about you. This is probably one of the biggest plights and one of the biggest tricks of the mind. You know, we feel a sense of we will get our own back because the market has done us wrong. And this is very dangerous. The number of blown accounts where people will say it's from revenge trading. And yes, there are underlying emotions that come here. Most prominently anger, which we talk about in a previous Mind Mastery episode. The thing here is to recognize revenge trading. And how do we recognize it? Well, the way to do it is ask yourself before each trade, am I sticking to my entry and exit strategy? Am I being patient? Because if you are jumping in after a losing trade again within minutes, then you are clearly revenge trading. You have to have a system in place to prevent this. For me, it's going for a coffee. For me, it's not trading at all that day. If I have a losing trade, because I know it's a normal part of trading, I'm not trading again. And yes, I have been there. I have revenge traded. I am not no saint of trading that I was able to not revenge trade. Yes, I've been there. But I know because of experience that leads to the worst outcomes. There is not a good trader out there with a track record that achieved it from revenge trading. Just doesn't exist. Why? Because if trading was successful from anger, well, I guess then all the angry people out there would be good traders, but that is not the case. So revenge trading is one of the biggest tricks of the mind. You will be emotionally challenged in trading, and anger is an emotion, and any emotion that all humans feel. In actual fact, it's probably one of the ones that are most likely to occur over and over again. And so what you've got to recognize from a basic level is, what is the time difference between you losing a trade and entering again? Because it should be a day. That should be a golden rule, especially if you are really getting angry all the time. You should be waiting at least a day. And if you've not got something like that in place, well, then you deserve to allow the market market to really play you the fool, because that is what will happen with revenge trading. You will be played for the fool. And trick number 3, FOMO. FOMO is another big one. FOMO is one I hear of a lot. I used to get FOMO all the time. And FOMO is a tricky one. Why? Because let me put it this way. This is the way I think about it. The market will present you with endless opportunities. It is your job as a trader, as an investor, as a participant of the financial markets to only identify or only enter the opportunities that suit your strategy, your risk profile, right? When you wake up, there are candlesticks going off left, right, and center. There is things going on all the time in the markets. The market will present endless opportunities. Not every opportunity is equal or the same. And this is why FOMO can really affect people, because they simply see movement and they equate movement to opportunity. No, just because the market is skyrocketing up, does that mean it's an opportunity? No, unless your strategy has been refined over time where you know or you have a way to enter and exit during high volatility. Volatility doesn't mean opportunity. And look, there is a caveat there, because yes, volatile times do present opportunity, but the point I'm trying to make is that the market will trick you into thinking there are more opportunities that are good than there are bad, when in actual fact, it's all about knowing when to enter, being patient. And we speak about this. Patience is the crux of this trick of the mind. And look, all of these tricks of the mind are related to some sort of emotion or state of mind that we spoke about, right? With FOMO, it's patience, okay? Or greed. With revenge trading, it's anger. The first trick of the mind, attachment, it could be hope. And so there are emotions that play into all of these, but what we're doing today is actually looking at the way they trick the mind, right? So we're relating this all together. And with FOMO, it is the impatience, it is the greed. So if you're suffering from FOMO, what I would say is that you go back and watch the episodes that we cover with patience and greed, because that will help you. And the key here is to understand that not every opportunity is a good opportunity. And number 4, perfectionism, the need to be right. Ego. This is one where it's almost like a validation of your ego, right? It's like you're trying to prove something to yourself. And again, I know I repeat this all the time, but the market doesn't care about your validation or your ego. There is no need to be right or wrong. There is simply applying a strategy and using risk management. Why is this the case? Because ego has no place in trading, right? And look, I see this all the time, especially with losing trades, where people will cling on. Why? Because they cannot accept the loss because of their ego. You know, oh, I can't have a dent here, I cannot accept this. And yes, there's hope that is creeping in here that is really fueling the need to be right, okay? But there is just no place for perfectionism. The market shouldn't be perfect, so there is no dent in your ego. It is just simply a case of you versus you here. And again, that is the trick of the mind, isn't it? It is simply you versus you. And so what you've got to recognize is that idea of being right or wrong shouldn't really factor in. The idea here is, what is my strategy? How can I make it better? And there is no right or wrong. And do you want me to tell you why? Because there are a million ways of making money from the financial markets. People have different ways to trade, different entries and exits, different ways to look at their risk management, different ways to manage their trade. Is one right or wrong? No. I hear all the time people be like, I use this indicator, or I use this strategy, or somebody used this, it was wrong. What you're actually doing there is you're using your ego and you're applying right or wrong in the wrong way when it comes to trading. There is no right or wrong. There is no perfectionism. There is no ego. It is simply a strategy and risk management and refining it over time. That is all there is when it comes to financial markets. You can be wrong many times, but that being wrong doesn't necessarily equate to not making a profit. There are traders there that have a 10, 20% win rate, yet they are very profitable. Why? Because it's not about wrong or right. It's about probability, risk management, and strategy. There is no place for ego. There is no place for perfectionism. It is not a place to be perfect. In actual fact, the imperfections is where you can improve. And that is why perfectionism does not exist, and it shouldn't exist. And that is a trick of the mind that you should drop and forget about. There is no place for ego. And trick number 5, overtrading. Overtrading is, it kind of ties in with market presenting opportunities, right? Boredom, dopamine hit. I think there is a sense of wanting to be in a trade that really really drives overtrading, right? They feel like if they're not trading, they're not doing something right. Almost confusing action with a good call, right? Just because I'm taking action doesn't mean that it's necessarily a good move. The market's going to present many opportunities. Do I take them all? If I don't see an opportunity in a day, is it right for me to just jump in and take an opportunity? And I think at the core of this is a dopamine hit, is the feeling of being in a trade, the exhilaration of being in a trade, the excitement, the emotions. And there's that word emotion again. If it is an emotional kick you're looking for being in a trade, then should you not be at the casino? Because that is where you will get the ultimate emotional kick. But trading should be boring. Trading shouldn't really bring you a sense of fulfillment through emotions. And yes, we will feel some emotion, whether we win or lose or leave profits on the table. This is why we have the Mind Mastery series, to recognize when we feel like this and how to cope with it best suited for having success in the markets. But overtrading, trading for the sake of it, that is not good. I think trading really is one of the industries in the world where you are tested for your patience, for your inaction. And I think a lot of people confuse action with positivity, with a positive outcome. Look, if you're in another job or you're trying something else, action is required, right? Inaction is where you might find the best results, really waiting for the market to come to you. So you are trading the markets and the market isn't trading you. So this is why overtrading is another trick. The mind is saying, place a trade, place a trade. You have to do something. You've not placed a trade today. You're not doing work, but you have to battle that, because that is not really what the markets are there for. The markets are there for you to try and find or be presented with the opportunity that suits your strategy. And remember, there is no wrong or right. We have discussed this. There's no wrong or right. There is no wrong way to make money in the markets. But the idea here is that the market will present many opportunities, but not all of them are good. And this is where the overtrading comes from. You cannot sit there and allow your mind to trick you into taking action because that is somehow good, because it is not. So that is overtrading. And trick number 6, and this is a personal favorite. I actually love this one. Sunk cost fallacy. For all of you that doesn't know or don't know what this means, it simply means you've entered a trade or you've bought a stock, you're in it now, and because you're in it, you feel indebted, you feel the need to have to stay with it, you have to stick with it because you've entered. And this can be the detriment of a lot of people in the markets. The best example I can give you is people going in without a stop loss, right? Or you buy a stock that goes down 50%, and now you think because it's down 50% or a trade is down and half your account is blown away, that somehow you have to stay in it because you feel indebted to it. This is so dangerous. The sunk cost fallacy is one of the most dangerous tricks of the mind. You have to have a stop loss. Why? Because we already have discussed time and time again that you cannot be 100%. So if you cannot be 100%, therefore accepting that there will be trades that you will get wrong, you have to have a stop loss, because you don't know what trade that will be. You could have 6 winning trades, 7th one comes in, and that is a losing one. And that is the one where your sunk cost fallacy might come in, and all the hard work from those 6 trades that have stacked up on top of each other suddenly fall, completely gone. Why? Because you feel indebted to the 7th trade because you've won 6. Sunk cost fallacy is so dangerous. And look, like we discussed before, that the market will present many opportunities, not all of them are good. You have to understand that from time to time you will take bad opportunities, and when that happens, you cannot be indebted to that opportunity that you took. Why? Because when you are in that opportunity, you will miss other ones. And yes, there is opportunity cost, which we'll come to, so they all relate. But sunk cost fallacy is recognizing that just because you're in a trade, just because you buy a stock, just because you have an options contract, it's not going your way, that you don't have to remain in that position. In actual fact, because you remain in that position, not only could you lose more and more, because if it was the bad opportunity which you have taken, meaning that you need to wipe it and move on to the next, you're just adding more fuel to the fire. You're adding more energy to a bad trade, to a bad opportunity. Sunk cost fallacy, I've seen so many people who, will say, I didn't have a stop loss. And why? Because they feel indebted to that trade. Such a major trick of the mind that you need to recognize and really grasp of, right? If it doesn't go your way or you get it wrong, so be it. Don't put any more time and effort into it. The opportunity cost here is massive, and I believe this is one of the most dangerous tricks of the mind. And number 7, outcome bias. This is one that doesn't regularly get talked about. Outcome bias is equating good outcome outcome with somehow being a good process. Let me give you an example of this so how you can actually understand this. So let's say you have been implementing a strategy, you've been using risk management, and you've been losing some trades, winning some trades, but you're refining over time. You're journaling, you're doing all the right things, you're staying disciplined and focused, you're recognizing when certain bad emotions are coming into play or emotions are coming into play that shouldn't be, and you're improving just as you should be. You're evolving. You get to a point where you're finding consistent profits. You are, again, just doubling up on that. Once you find the recipe that works for you, because there's no right or wrong, you continue with that, you continue to tick the boxes, and you continue to produce consistent profits. But then there comes a time where you break the rules. You don't listen to your entry or exit, and you are being impatient. For whatever reason, you break the rules, but you come out the other end successful, and suddenly you start questioning all that hard work for months, for years. Or maybe this is a new way for me to make money in the markets. Maybe this is a new way for me to employ into my strategy. Let me change stuff up. And suddenly you broke the rules, you broke the process, and because of luck, you're equating this outcome, you have an outcome bias, with suddenly being a good thing, and you start breaking the rules more. And before you know it, you get a loss, you get a bigger loss, you revenge trade. You revenge trade because you're not sticking to the rules and strategy. You become impatient, you start relying on hope, you get greedy, then angry, disappointment, you start doubting yourself. Look how these things are all linked, all because of one singular mistake. Outcome bias, very powerful. Listen, just because you get lucky from time to time isn't a reason to just take your strategy and chuck it out. Absolutely not. If you have something that works, you've developed it, then you should be really jumping on that and doubling up on that. Don't change things drastically, right? There's been times when I'm lucky. There's times when I don't listen to my own rules, stay in the stock market. I don't do the research that I'm supposed to be doing, my due diligence, my checklist. I'll buy a stock and I get lucky. I know absolutely it's luck. I've trained my mind to know that was a lucky time, that was a lucky shot. It just happened to be that the stars aligned for that particular trade, that stock investment, and I was lucky. And trust me when I say this, I have seen many of people have been trading or in the markets for years, and with a bit of outcome bias, it all goes down the pan. So make no mistake, this is one that isn't talked about, but this is a trick of the mind that you should not be ignoring. And we are on to trick number 8, loss aversion. This does tie into some of the other tricks of the mind, the hope side of things, just staying in a trade, sunk cost fallacy. But loss aversion at its core, this trick of the mind is because losses feel more painful than a win. The emotion of a loss will be felt 3 times more in the mind than the emotion of a winning trade. And this is why loss aversion kicks in. We will do anything, come to any cost to not lose. It's so dangerous that the crux of it, it's accepting that losses are an inevitable part of trading. And loss aversion is where you don't put your stop loss in because you don't want to feel that stop loss. And part of this trick of the mind, unfortunately, comes from experience. Said another way, to master this trick of the mind, it comes from experiencing losses. And what do I mean by that? Well, because feeling a loss is an innate behavior that's built into us, it's not something that we can just control from the start. It's something that we must sort of recognize over time. The unfortunate side is that we must experience loss after loss after loss. Let me give you an example. When I first started trading, getting into the financial markets, I was left with £30,000 at the time of my father passing. Look, I'm not trying to get sentimental here, but that was my spark to get into the financial markets. And we had some stocks. I moved some of the money in a spread betting account, and that's when I first started trading Forex. It was gold. It was the first time I had put on a trade. Spread betting, I won't go into it. It's a different form of trading, but it's a form of trading nevertheless. And so I put money into gold, and I lost money very quickly. I gained money very quickly, but one of the things I had to battle was loss aversion. And that was recognizing that losses are going to be inevitable. And yes, they hurt. They still hurt, but I know they're a normal part. In actual fact, I spoke about this in previous episodes. A loss is a box being ticked. Of course it is, because we cannot be 100%. So when you experience a loss, you simply say to yourself, that is expected. Cool, I've done my loss. Right, let me look on to the next trade because there's opportunity at cost. Loss aversion, do not try to avoid losses. Accept losses. They will happen. And the sooner you can do this, as sooner as you can get around the trick of the mind of not wanting to feel the pain of a loss, then the sooner you can move forward to the next opportunity cost. Number 9, confirmation bias. We always want to be right. Put on a trade and be like, oh, the candles are moving the exact way that I envisioned in my mind. That's not going to happen. Get that out your mind. That's never going to happen. Some of my best trades, some of my best setups come from times when there is uncertainty in the markets. In actual fact, that is the same with stocks. I'm best buying stocks when there's a disconnect between reality and what the underlying data, the fundamentals, the technicals, the qualitative, the quantitative is telling me. And that is the same as a trade. When I enter a trade, it's never going to be obvious. If trading was obvious, then the setups would be picture perfect every time and it would be like artwork, right? But that's not the case. The seeking of comfort comes from an evolutionary standpoint where comfort and safety, it's something that we all seek, but the market goes against our innate evolutionary behaviors, and therefore the seeking of validation is not going to happen. Confirmation bias will take you out a trade quickly, and this is where fear comes in. We're relating this back to a lot of the emotions that we've talked about, states of mind. We enter a trade, the candles aren't performing how we want. In actual fact, it's staying in drawdown for way longer than we anticipated. Fear kicks in, you start closing half your positions. And then on the other side of that, it starts going your way. You hit your first profit target, but it's not going the way you want because it hits your first profit target and comes back down again. And suddenly you get fearful that it's going to go the wrong way, because why? You're not getting the confirmation of what you envisaged in your mind. You close out early, only for it to go up, and the trade executes the way that you had envisioned. Initially thought of the setup according to your strategy, according to your entry and exit. Had you just stuck to that process and ignored confirmation bias, ignored being comfortable, then it would have played out for good or bad, because even if it hit stop, at least you stuck to the process and you can reflect on that, rather than using the confirmation bias of the candles didn't look the way you wanted, the setup wasn't going the way you wanted in mind, so therefore you came out. And it comes down to that thing where you're chucking your process out, right? I mean, we spoke about this already on Tricks of the Mind. Because it doesn't go your way, or you get slightly lucky or unlucky, you throw your process out. And confirmation bias is part of that. Don't seek comfort. Don't seek validation. You shouldn't even be seeking validation in other areas of life. Stick to a process, stick to a strategy, no matter what the outcome is. Remember, the mind will seek the comfort and validation, so therefore don't think that if you don't see what you envisaged, what you hoped for, there's hope, remember hope, then it doesn't mean that the trade will not go your way. And that is confirmation bias. And trick number 10, we have recency bias. And recency bias is more of a expecting things to go the way they are going because of what has just happened recently. So there are two sides to this, right? The first side is you're on a win streak, so you expect the win increase to continue. You get overconfident and you might start throwing your strategy out the window. You might not wait for your entry and exit. You might just simply go for it. Why? Because you're the king now. You're the god of trading. You've had 2 months without hitting a stop loss. You'll never get it wrong. Why should you? Why can't I go for 3 months, 4 months? Completely wrong. Just because of what has happened recently doesn't mean it will happen again. Let me give you an example of this. Do you know if you flip a coin 1,000, 10,000 times, there will come a point where 6 times, 10 times in a row, it will just become heads, 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 heads. But just because you have 10 heads in a row doesn't mean that the 11th time will be another head. That is almost like recency bias because we're using probability here. There is a probability that from time to time you will go on a win streak. That will happen. That is expected. But you have got to understand that no matter if you're in a win streak or a losing streak, that does not reflect upon what will happen tomorrow or the next week or the next month. It's got nothing. Past performance isn't an indicator of future performance. You know, you hear this all the time in the financial markets. You're probably bored of hearing it. In actual fact, you've heard it so many times, you probably don't even listen to it anymore. And the same way, if you're on a losing streak, just because you're facing loss after loss after loss, doesn't mean that the next one will be a loss. Again, it's probability. So sometimes the market conditions will not favor your strategy, and sometimes they might favor your strategy down to a T. And what you have to recognize here is that the actions of what has happened recently does not affect what will happen tomorrow. You simply stick to your strategy and your entry and exit, your risk management to a T, keep refining and adapting, and try and not take too much pride or ego in having a win after win, and try and not take too much disappointment or doubt after taking a loss after loss. And look at the emotions we're tying in here with the trick of the mind. All of these tricks of the mind will be tied to some sort of emotion mindset. It's really recognizing what tricks are played on the mind as a result of these emotions, right? So that is recency bias. So look, let's conclude. The tricks of the mind is one of the most important things of the financial markets, and you've got to remember the market doesn't care what you do, but the only thing you can control is how you recognize the tricks of the mind and overcome them. And we have covered a lot here. This was a big episode. I really enjoyed filming this one because these are things that I've recognized in myself. They tie in with the emotions, with the rest of the mind mastery. And after watching this episode, I will guarantee when you go back and watch the other mind masteries, they will make more sense. Not that they wouldn't make sense before before, but you will relate to them more. It's like watching a movie again and noticing things that you didn't notice the first time. What I want you guys to do is drop a comment and let me know what mental trap have you fallen prey to in your journey in the markets. And there might be things that I've not spoken about, and we will speak about them in the future. So drop the comments, let me know. I'll be back with another episode. Let's go.